30,000. That's not just a number, it's much more than that. For the third time in history, Sensex touched this historic mark. Good evening and welcome to this special show, Bulls Charge Ahead. I'm Lata Venkatesh, with me Surabhi Upadhyay.
Well, Lata, yes, celebrations on the Lal Street today, and I believe a 30-kilogram cake, if not 30,000, but at least a 30 kg cake is what we saw at the VSC today. But before we get to the analysis and the experts, just your sense on this phenomenal rally that we're in the midst of.
Let's face it, this is a global rally. There's a huge global tailwind. It's not just that Europe has been saved for the moment. There seems to be earnings growth. Caterpillar, DuPont, 3M, McDonald's, all of them beat estimates overnight. And in India, overnight again, MMFSL, LIC Housing, Can Phenoms, and I think Swaraj Engines. I mean, I could go on. A bunch of mid-caps beating estimates or at least improving asset quality. Again, I spoke to Aditya Puri and he sounded that, the best is yet to come. That FY18 is definitely better than FY17 and he has had a brilliant FY17. So, while there was one hiccup at a point when the market went below 30,000, clearly the market is smelling growth and is, trying to discount that. No two ways, bulls are in full control.
Oh, absolutely. Let's bring in Anuj as well. Anuj, what did you think of today's action? And there was that little bit of wobble around 2 o'clock when the mid-cap market started seeing a little bit of a sell-off. But, your overall sense on the huge momentum that continues to build?
Well, Goldilocks scenario playing out for market right now. Everything is going positive. There's DI buying, which has been there ever since demonetization. The FI buying has also returned, albeit in small numbers, but there is buying. And global and local cues are looking supportive. Global markets are expanding. There's also economy-facing earnings which are doing well. ACC, Ultratech. We saw with HDFC Bank what happened there. And look at the way the market is being driven by old economy stocks, banks, autos, cement, infra. This is a market which is now sensing capex expansion, which was something which was missing. And I tell you something, a lot of people ask me what next. There's clear sense of buyer's panic right now. Many experts that we speak to on channel say that they now want a correction. And I tell you something, it's not a need for correction. It's the fact that a lot of them have missed out on this market rally, and that's why it's a hope of a correction. Whenever you have hopes of a correction, markets normally don't oblige. As you saw today as well, intraday there was a dip, but that was bought. All corrections are lasting very short and are just moving on. This is a market which is in a firm grip of bulls, and as of now, we don't see any evidence or any reason that that should change.
Well, joining us now to discuss the markets further is Gautam Chhaochharia of UBS Securities. Gautam, thank you very much for joining us at what is a celebratory moment for the bulls. But tell me, you have the courage to buy now?
No, not really from a near-term perspective. Absolute levels where markets are. And even if you look at our upside scenario for Nifty, which is 9,700 by end December, the risk reward definitely is not attractive. Our base case is 8,800, which suggests absolute downside. But even if we assume that the current market momentum continues in terms of global reflation hopes, the local recovery hopes, even then we can't really see from a fundamental perspective markets overshooting 9,700. But obviously there are other technical factors at play.
Yes, I agree. But, markets always smell growth or are discounting a future. And you've seen enough number of results. Are you getting a sense that spring action of earnings burst is coming? Is there evidence in the Q4 numbers?
Not really in our view. We did see some surprises, specifically in cement, but that could be just one sector, 1 month numbers rather than any broader trend per se, because that sector also saw very, very weak Jan and Feb. And because of that, our guess is that the market expectations were overly pessimistic and the numbers came as a respite. Is it a beginning of a trend per se? I wouldn't like to extrapolate based on 1 month's numbers because that's what the numbers suggested. Specifically given the other parameters or other indicators which we have got numbers for March already, they don't suggest any such recovery.
Okay, so that's a bit of a cautious stance, Gautam, then. And what's really fueling this rally? Is there anything more to it than just pure liquidity? And are you a bit sanguine about the rest of this earnings season? Where is your concern in terms of sectors?
So liquidity is a lazy argument, but definitely the global reflation hope is helping risk-on environment globally, and that's helping Indian markets also. And within India, as you said in the beginning, there is hope of a recovery building in, and we have seen this hope building in over last 4 years. Beginning of the year, the next fiscal year hopes, second half recovery hopes, they always come back strongly in India, given that inherently India remains a high growth potential market and economy. So that's what's happening as we speak, and it's also happening in the backdrop of some very, very pessimistic expectations post the demonetization event which markets are building in. And obviously the last technical factor is the local flows being very, very supportive, and that's driving a lot of market sentiment and willingness to be comfortable with higher valuations. Having said that, it does not warrant the current valuations for markets in our view from a fundamental perspective, and therefore entry at this point is definitely, we'd advise caution. For longer term investors, the India story is always intact, always looks good, still remains the case. In terms of sectors specifically, we would advise cautions on the industrial and capex, because the recovery hopes there seem to us the most misplaced, because we don't see any evidence of broad-based capex recovery. There are bright spots which have been there over the last 2-3 years, and we will continue to see those bright spots, but a broad-based capex recovery seems misplaced in our view.
Gautam, investors will make their monthly salaries and want to put aside a little, and maybe more when they see the markets charging. What would you have them do? Buy, or relax a bit and wait for prices to come?
So again, we've seen historically also, when you buy at very expensive valuations, then at least for that part of the investment, you don't really make returns above the risk-free rate or alternative opportunities. And that's the framework we're looking at when we say that at these levels, the risk-reward is not favorable, because even if you build an optimistic scenario, we come up with a Nifty scenario of 9,700 by end of this calendar year. Which seems to us to be lower than what, say, a bond market of fixed deposits can offer you. Having said that, markets can always overshoot, but sustainable, fundamental-wise, it doesn't make sense.
Gautam, I believe you went overweight on IT at the start of this calendar year, somewhere around that time. Are you pleased with what you've heard from some of the top-notch players? Actually, we've had a flurry of mid-cap IT earnings as well. Are you satisfied with what you've heard and what you're seeing in terms of guidance?
Yes, so we upgrade the IT services sector to an overweight early in this year, I think somewhere around Jan and Feb beginning. And one of the theses behind our buy call was, one, the structural concerns about digital headwind for the sector, which was the reason behind our underweight stance for the last 3 years, seems to have been priced in after the 30 to 40% de-rating in these stocks multiples. On the other hand, the cyclical upswing from pickup in US banking spending specifically, and even post-Brexit pickup in Europe spending, is something which we foresee to happen, but is not really priced in. So in that context, we did see some early commentary in this quarter's numbers about pickup or outlook for US tech spending picking up, but still early commentary. Even in our analyst view has been and still remains that the real commentary to turn positive, and that's when the stocks really start doing well, will be possibly for the June quarter, because that's when they'll have a better sense in terms of numbers and outlook for tech spending in the US. And specifically, one of the analyses we had run was, we have seen software spending pickup typically precede services spending pickup by 3 to 4 quarters. And even from that framework, it's the June quarter which will be the key quarter from our view perspective.
Okay. Prepare us for what we should expect from President Trump and how the markets might react.
That's a tough one, because
well, it's not 24 hours away.
It's also about it's also about what he announces, the details, and how credible the markets look at in terms of it being possible legislatively also, not just what he intends to do. But clearly the market reaction and expectation is positively biased in terms of expectations, because that's one of the key hopes into the Trump election win also, that tax reforms could be a big driver and help for earnings and markets. So it's obviously a big event, but very difficult to say how markets will react. It will depend on the extent and the credibility of the scheme.
Okay, Gautam, we know you like mid-caps, and I know you won't get stock-specific, but still, if there are themes where you think there can still be some kind of, wealth creation or excitement, whether it's tire, sugar, any particular flavor of that market that you like?
So broader mid-cap universe looks to us even more richly valued than the broader markets. In that sense, we would advise even more caution there. But there are opportunities where earnings visibility remains high. In fact, at the stock level, there are stocks where we see possibility of earnings upgrades. But segments where we remain positive because of the earnings outlook are in the entertainment space, are in the space of specific consumer durables, in the space of exchanges, etc. But you have to pick and choose your stocks even beyond segments, because we have seen over the last few months and even now quite a big gap in terms of stocks within a segment in terms of multiples as well as earnings outlook.
Well, your caution is well taken, and the way in which you have hedged your mid-cap bets as well. Yes, and I was being unfair to you about the Trump question, but it is just that since markets are betting so much on the Trump trade, whether tomorrow would be an occasion to take profit was my fear. But I guess we will know it in good time. Thank you very much for joining us with your thoughts on the market. We have to take a break. Let us leave you with some more thoughts that we got from market experts. Sanjeev Prasad of Kotak Institutional Equities is again, like Gautam, sounding a word of caution. He says that although stocks have been rallying over the last few months, there is no real change in the fundamentals on the earnings side. But on the flip side, Jeff Chaudhary of LGM Investments says that 30% of their emerging market allocation is in India, and they are quite happy to make incremental allocations even at the current juncture.
You have to look at every stock on an individual basis and see if it meets your investment philosophy and your whatever investment style you are following. If it does not, then you take a call accordingly. Ultimately, if stocks keep on going up, there has to be some fundamental rationale for that. And honestly, over the last 1.5 months, the kind of stocks that are rallying without any real change in fundamentals, I guess one has to, if you're a fundamental investor, still sticking to your core investment philosophy, then you take a cautious call, I guess. So it depends on sector to sector, stock to stock, I would say.
India is the biggest allocation for us in our global emerging market funds. So we have almost 30% of our global emerging market fund in India. So every day it makes a new high, we're happy. In the private sector space, we continue to like the banks. That is a very broken record on our side. The private sector banks, HDFC Bank, Yes Bank, continue to be long-term favorites for us. So I'm afraid it hasn't changed very much, even though the market has gone up. And we still like those companies very much.